below. So, coming to the topic of today's discussion, never ending correction, is it time to quit markets? See, don't blame us because this is exactly the question that we get very regularly, and we are, we have no other option but to address this query in different ways possible using data in uh, various formats to drive the message real hard for you. In fact, the kind of messages we get are, we started investing 1 year back. Should we should we pause our investments, or should we exit our investments and consider coming back into the markets once Sensex or Nifty breaches a certain resistance, or once there is a 5% rally or a 6% rally, 10% rally? So there are various kinds of questions we keep getting from investors, especially new investors. And long-term investors do understand all of this, and they are very much settled. So we've also seen data, plenty of data, on how the last 5 years have been massive in terms of the number of new additions that have been there in the market. So it's quite understandable, and it is our duty to sort of communicate the right message and ensure that you have the right mindset developed to tackle markets like these, especially, right? So, see, we've been hit by a five consecutive red bar on a monthly time frame. So we've taken Sensex for this analysis. Sensex has been making consecutive sort of lower highs and lower lows, and we are currently at 74,611. And it does look like maybe we are going to come back and retest the general election results day low below 70, 72, 71,000. Maybe that is the area where we might finally find some support for Sensex. But again, that is again speculation, and we don't want to get into all of that. But the point that I would like to make to you is that, see, there can be a phase like this as well, especially if you're someone who started investing in this phase. Please be prepared for this kind of a phase as well. So market saw a remarkable rally post COVID, going all the way from 25,000 odd levels, reaching 59,000. From there, there was a correction for almost about 1.5 years. And finally, there was this breakout that happened in 2023, and we are once again seeing a great rally. After this rally, again, we are seeing some sort of a pause in the market. So, rally followed by a pause, rally followed by a pause is the structure of the markets. Please do understand this very clearly. And as I mentioned, I mean, even if there is to be a sort of a correct consolidation phase for the next 1 year or a couple of years, there is no problem, because just take a look at this chart that I'm going to show you. To zoom out of the same Sensex chart for some context, we are currently on a 9 year positive streak when it comes to Sensex performance, starting from 2016 onwards all the way till 2024. 2025 is this red candle that has just started. It's just been a couple of months, and we are seeing a negative bar. And please don't be surprised. I would personally not be surprised even if we see a positive bar towards the end of this year, because we saw what happened during COVID. I mean, such a massive scare that happened in the markets. It did not last for more than 4 or 5 months. The correction happened, and then very quickly, markets recovered to hit a new all-time high within the same year and closed very strongly too. I wouldn't be surprised if that happens. Now, one can go ahead and argue and say that, of course, yeah, you can say that we are on a 9 year positive streak, but we also had these positive streaks back during 2003, 2007, and also during 88, 90, 94. And this current bull rally is nowhere close to the past rally. We totally understand. Yes, that is fine. I mean, Indian markets have also moved to a more mature and progressive style in the last decade or 15 years, especially post the GFC crisis. We have seen many data to convey that message as well. So just to give you some context here, this is the consecutive years of profits and loss that the markets have been making. We'll come to the question whether to exit or stay in the markets or to invest in the markets a little later, but this is just to showcase what the current status of the market is. So we analyze all the previous bull runs also here. So in terms of consecutive positive years, this is the maximum, right? So we are currently on a 9 year positive streak. There is absolutely no harm, even if there is a 1 year a sort of a negative streak going forward too. There is no problem at all. This is 2025. Of course, you don't want to take that into consideration, but there is no harm even if that happens. It is, in fact, very good for the markets. If you see, after every single phase of consecutive performance, starting from 1979 all the way till 85, we had a 6 year consecutive positive phase, yielding a CAGR of 28%, followed by 2 years of correction in 1986 and 1987. And then once again, the next phase, starting from 88 going all the way till 1994, 36% CAGR across the 7-year consecutive positive streak, yielding, followed by this dull period where we saw positive years and negative years being sandwiched, right? Between 1995 going all the way till 2001, 2002. So 2002 onwards till 2007, of course, a 6-year positive streak yielding 35% CAGR once again, followed by a dull few years of performance in Sensex. Yet again, after 2015, 2016 correction, we are currently on a 9-year positive streak. And this year, mind you, has not ended as I mentioned before. We don't have, I mean, wouldn't be surprised if we hit the first time where we are currently at a 10-year positive streak. I wouldn't be surprised if that happens too on Sensex. But this time, the CAGR has only been about 12.9%. So, from another context, see, from one side, there are complaints stating that there is a 5-month consecutive negative performance on Sensex, and just take a look at this data for God's sake. This is the kind of remarkable performance that the market has put out in the last many years, right? So there should not be any reason to complain whatsoever, no questions at all, even if there is a consolidation phase for 1 or 2 years, which is great for the markets, by the way. Now, your journey in the markets can be smooth and enjoyable. So, see, the objective is not to only make money, right? See, if you are going to approach the markets with an intention to only make money, it is not going to work out for you, right? If you're studying for an exam, if you approach the exam with an intention to, if you're focusing only on getting 95%, 98 or 100% marks, right, your journey does not become more enjoyable. So you should focus on your journey being enjoyable as well in the markets. And that will happen only if you understand how the markets work, how to have the right expectations for the markets, and who will the markets favor. What kind of investors does the market continue to favor over years and years? That is something that you need to be very clear about. Now, coming to the question we are answering, I'm trying to tie all this down to a very good summary that will keep you calm ahead during the correction as well. Should you exit the markets? In fact, let me go one step further and say you can invest in the markets, right? I mean, I mean, if you've been following weekend investing, daily bites, or or content in any format, the nuggets or whatever it is, you will know what answer we are going to come out with. But here we are trying to drill this data drill this message using convincing data, using data that can help you create a very, very stable, robust mindset to make your journey smooth and enjoyable, right? Even during corrections. So it should, I mean, irrespective of whether it is a correction, whether it is a bear market, bull market, whatever is happening, your journey should be good. And that is exactly our endeavor in these episodes, to try and give you data in such a way that it convinces you to, altering your mindset in such a way that uh, it is more rewarding from an experience point of view. So let's take a quick case study. Even if you started investing at the worst possible time in the last 20 years, right? Let's say you're someone who completely missed out on this rally. You were waiting completely during this phase, 2003, 2004. You saw this correction. Now you want to wait for this top to be taken out. You have completely missed this rally, and you're somewhere near this peak, and you finally decide to start investing after everybody around you has made tons and tons of money. You finally enter the markets, and you decide that, let me start investing, let me do a SIP, right? If that is the popular instrument, let me start investing using SIP. And then you are greeted by the markets with a fantastic drawdown of 63% and almost no return for the entire decade, right? There is a magic pill that you have, right? The magic pill is called SIP, right? So let's take this case study, and this is a very interesting graph. What it indicates is the current value of your investment. So let's say you started with an SIP of 10,000 rupees per month, exactly at this particular peak, and you continued your SIPs, right? This chart shows you the current value of your investment as the market progresses, as you keep adding SIPs, and as the market progresses, as a percentage of the total invested capital using via the SIP, right? So let's say you invested 100 rupees. You've been investing 100 rupees month one, 100 rupees month two, 100 rupees. So your total investment is 200. But let's say your current value of the portfolio is also 200 at that point in time. This value will be exactly 0%. Right? That is what we are trying to show. So this is showing the excess. I mean, what how much your current capital is down compared to the amount you have invested. So just to indicate the kind of pain that you might have gone through. let's go through the worst phase in this journey. October 2008 was the worst time because your current value was 34% lower than the amount you invested, right? Whereas here, if you had invested a lump sum at this point in time, the drawdown that a lump sum would have triggered is about 63%, whereas through SIP route, the pain is much lower, is what I'm trying to convey using this chart. So if you started an SIP of 10,000 rupees by November 2000, when this the starting point was December 2007, you went through a massive correction. You invested through the fall, accumulating at lower levels of the market. So your current value was only 34%, 36%, in fact, lower than what you'd invested. So just take a look at the kind of, I mean, it becomes much easier for you to digest the correction if you're doing your SIPs. So, and just see what happened later. After this correction got over, December 2007 is where you started, and this is what, April 2009, right? So in exactly about 2 years time, you recovered all the money, and this is where you started making some gains on your capital as well, right? Of course, after a year, you after about a period of 5 6 years, once again there was a phase where the current the current value was equal to the amount invested, right? So December 2011 here, when it's 1%, and here May 2012 it was about 5%, and the current value was 5% greater than the amount invested. But after this point, there was no instance where your the current value went below the amount you invested, and it just kept increasing over time. So even if you're investing at a time when the market is staring at a longish correction phase, there is absolutely no problem, is the message that we're trying to convey. Because at the end of this entire period, the SIP XIRR that you would have you would have got was 11.3% compared to the CAGR on the Sensex. If you had started at that point in time, would have been 7.8%. So just keep all other assumptions away for just conveying the matter, right? So it is absolutely cool. This is called magic pill for a reason. Let's embrace the magic pill called SIPs. This is something for all seasons, right? So it is absolutely endless. You don't have to worry about whether to accumulate, whether to pull money out of a certain instrument and invest in the markets just because the market is looking very good, just because someone else is making a lot of money. No nonsense whatsoever. Just keep it extremely simple. It is called the KISS principle. Keep it simple, silly. So it is very simple. Just start your, irrespective of what the markets are looking like at any point in time, just start your SIPs. Forget about what is going to happen. Continue your SIPs during correction, because that is exactly the point where you are basically going to add. You're going to sort of invest in the markets at much lower levels. So that is going to give you that alpha. That is going to give you that kick when the markets also start to recover. That is the part which ensures that your, ideally your XIRR is quite good over a longer term, even if you started at the worst time ever. So it is a great opportunity. Treat this as an opportunity, in fact, rather than trying to find reasons to stay away from the market. Treat it as an opportunity to invest at lower levels. It is a great opportunity. It doesn't come very regularly. Let me be very frank to you with you, right? So corrections don't happen very frequently. I mean, as you saw, 9 consecutive years of positive performance. Every time a correction comes, it should literally open your eyes, and you have to think from the perspective of trying to treat this as an opportunity to add at lower levels of the market. Keep continuing your steps. Don't worry about what happens, and also focus on the things that you can control. Things that you can control are asset allocation, right investment vehicle, giving time to the markets. These are the things. These are the input metrics, right? The output metric being the final outcome or the performance, which is completely not under your control. So your all these things are under your control. What kind of asset allocation principles you want to practice, what is right for you, which investment vehicle you should choose, so that your journey can be good, and or which suits your philosophy. And also the final aspect is to give time to the markets, right? So let me know how you what you thought about this episode. Let me know if this sort of prompts you to invest more money in the markets, and I would like to see your comments basically on whether you think one should continue their SIPs during corrections, and also give your experience from the past in terms of how your SIPs turned out during corrections, and what kind of mental struggles you had to overcome during that correction phase where you were doing your SIP. This will benefit a lot of new folks that have come to the markets. It will prompt them to listen to your comments, observe your views, your experience, learn from your experience, and also translate that into and take it into their own learning. So that's for today. That's it for today's episode. Thank you so much for joining in. I will see you in another episode. Bye.